Hello, everybody. Happy Wednesday. I mean, the market, well, we're recovering now, but again, we're seeing this market all over the place. And what is driving the market? It's the bond market, it is interest rates. And we're seeing that 10-year, we talk about that 10-year just keeps pushing higher. So that is what is really being the leader in the market right now. All right, happy Wednesday, everybody. Can you all hear and see me? Okay. Let me know in the chat, please. I'm still getting used to this new platform that we're using. So if you can let me know that, that would be great. Awesome, Gilbert. Thank you. Thank you, thank you, thank you. Steve, Outdoor Adventure, thank you. All right. So, as Outdoor Adventure did about a minute or so before we went live, come on, smash the like, guys. Let's do it. Harris, thank you. Gilbert, Steven, smash that like. We need it. We need it. Okay. Couple of PSAs. Number one, public service announcements. Number one, remember, markets closed tomorrow. Okay. Markets closed tomorrow. So, what that means is any expiring position for this Friday, what's going to happen is theta, okay, option decay, doesn't care if it's a weekend or if it's a holiday, that theta still happens. Okay. So, option decay still is going to happen tomorrow, even though the markets aren't open. Now, volatility will most likely remain high until Friday morning because Friday morning we get the jobs number. We get the December jobs number. So they kind of may offset one another, but especially with tomorrow being an off day, Friday is really, really set up for some possible fireworks. Thank you, Zora. Thank you, thank you, thank you. All right. Now, also, I'm trying to chat you guys, but this is annoying that I can't see where to chat everybody because I know yesterday there were some requests to post in the chat a link to yesterday's matrix that we put up there. Hang on. Okay, the debit credit matrix. And oh, beautiful. There it is. Does everybody see that in the chat? That hey Thomas, that bit.ly link that is down there. Okay, that'll take you right to this. Hang on. Right to this matrix from yesterday. Okay. Awesome. Gilbert, thank you, thank you, thank you. Wonderful. All right, now let's get this off the screen and let's talk about kind of a continuation from yesterday when we talked about what really is VEGA. Okay, let's talk about the V's. And in my intro today, I used three V's: volatility, VEGA, and what else? VIX. Okay. What I didn't put in there that I could have, okay, making a fourth V, was volume. Volume can be a great indicator as well, but we'll do that another time. Okay. So, yeah, here's my little thingy today. It's the flying V, the goose, the seagull flying V. But what is in a letter? Volatility, VEGA, VIX. Okay, super important. So, volatility, okay, let me ask everybody a question. You're driving down the road, whether you're in side street, the highway, doesn't matter, driving down the road, all of a sudden, unbeknownst to you, you see the police flashing lights behind you. What does that do to you? How does that make you feel? How does that make you feel? Nervous, yes. Scared, cautious, yes. Hearts, okay. All of the above. All of the above. Yes. Okay. That's volatility, right? And what causes that? A surprise, the unknown, right? Something that's happening out of the norm. Okay. So now think about those same feelings and put it into the marketplace. When does volatility start to rise in the marketplace? When do people get nervous? When do people start looking for protection? When I say protection, talking about downside, puts or whatever it might be. It's those same feelings, right? It's the uncertainty. That's when volatility picks up. When things are just chugging along, and if you were doing the speed limit, if you're in a 55, maybe you're doing 60, so you're fine. Boy, nothing's going to happen to you, right? Everything is just going along great. When the market is moving along smoothly, great. There's not a lot of concern, not a lot of worry. Volatility is very, very, very low. But then when the you know what starts hitting the fan, okay, that's when vol picks up, when our tensions rise. Okay. So I like to use that correlation to put it into perspective of how we feel. We get tensed up, we get jumpy and nervous, as many of you said. That's what happens to the market. Okay, we talked yesterday about VEGA. Well, VEGA is a measurement of volatility. How much volatility is there? Okay, again, another correlation. If you're speeding, okay, if the speed limit's 55 and you're going 65 and the police are behind you, all right, you're not going to feel great, but you may get a ticket, but 65 and a 55, not the worst thing in the world, right? If you're going 80, that's a bigger problem. And if you're going 100, boy, okay, same same feelings there. So how much volatility is there? And then the VIX, okay, for those of you that don't exactly know what the VIX is, other than what you hear on CNBC, Fox Business, any of the financial networks, that it's the fear index, the fear indicator. It stands for volatility index. And the VIX measures volatility in S&P 500 options 30 days out. That's what the VIX is measuring. S&P option volatility 30 days out. Okay, does everyone understand that? Okay, good. Good, good, good. So, we know about volatility, we know about Vega, we know about the VIX, but what about volatility and timing? Okay, what about volatility and timing? What is this beautiful looking, colorful chart that I have up on the screen? Okay, this is an implied volatility chart in what happens to be Palo Alto. And I'll pull in the live chart here, actually. So Just going to overlap this. Hang on. Okay, can everybody see that now? That's the same chart. I just have it now here instead of in the presentation. Okay, and what can we distinguish from this chart? Okay, what can we distinguish? Well, let me put the numbers in here. The red is 30-day implied volatility in Palo Alto. The green is 90-day. And the yellow or orange, it might be on your screen, is 180-day. Okay? Why does this matter? Why do we need to understand this? Why is it important, and why is the volatility different depending on the timing? Anybody want to take a crack at that? Thank you, Steve Leisman. What do you all think? Okay, and what do we see here when we go from the 30 to the 180? And actually, if I were to add in here another longer length of time, I'm going to add in a year, 360-day. What's going to happen? It's even smoother. Okay, why are we seeing that? Longer time frame, more likely to be at the mean. Don, that's excellent. What your options are: more time, less to worry about. Jeremy, volatility swings more closely to expiration. Robert, longer period of time, smoother average. So let me ask everybody a question. If you're doing a research paper, you're gathering data on anything, I don't care what it is. It could be baseball statistics, someone's batting average. It could be NFL defense, how many touchdowns they let up. If you're doing back testing, okay, looking at a stock, what happens the more data you have? Okay, what happens the more data you have? Let me take this off the screen here for a sec. Yeah, more samples gives more smoothing. Exactly right. Let me just put this up here. And if I were to draw, okay, if I were to draw something with a really long time frame, a big data set, okay, we're likely to see something like that. Okay, because over time, there's less outliers. And as we get closer and closer and closer in time, less and less data, we're more likely to see something that looks like this. Why is that relevant to trading? Why is that relevant to what we do? And another question is why, on the charts, at least that I use, okay, the charts that I use, whoa, I don't want all of that. Hang on. There we go. Why, when we look at volatility, do we only have this red line typically up there? Okay, why don't I have this and this up there? And really just focus on this red line, which again, this red line here on our charts correlates to IV30. So 30-day forward-looking implied volatility. Okay, Gene says we want current. Okay, any other answers? Why this is so significant? Come on, there's got to be more. There we go. We know the longer time frames will be leaning towards the mean anyway. Okay, Jeremy. What else? Think about those of you who are in one of my rooms. Think about our kinds of trades. Okay, what's the timing of our trades? Whether we use verticals or diagonals, calendars, whatever it is, what's the timing of our trades? Bam, Steve, exactly. And yes, Don, it certainly helps you decide which option to use, or more likely, Don, it's the flip side of that. It's the flip side of that. The reason we focus in on this IV30 is because 99%, maybe 98%, 99% of the trades we put out have expirations 30 days or less. Well, if I want to get the best data set for the trades that we're making, what I want then is the best set of data out there that reflects the exact type of options we're trading, 30 days or less. Okay? That's why we almost exclusively use IV30. Now, I don't have a problem if you want to trade, if you're more comfortable trading options 60, 180, 360 days out, that's fine. But when you're using an implied volatility chart to help you manage or to help you decide what to choose, if your sweet spot is using 3-month options, let's say, I want to focus in on this green data set then. The red's going to be irrelevant to me. Okay, so if most of my timing on my trades is 90 days, this implied volatility chart here in the green is going to be much more compatible and much better data for the trades I'm making. Likewise, if you're a longer term trader and you're going out 6 months, same thing. Use IV 180. So on and so forth. Does that make sense to everybody? It is so important. It is so important if you are going to trade volatility, and if you are going to look for these trends, do I want to get long volatility or do I want to short it? Do I want to buy VEGA? Do I want to sell it? You got to know the right support and resistance points for the trades that you're making. Okay? Make sense, everybody? So again, the reason that, when you go back to the rooms and you're going to see that volatility chart, the reason we use the red ones in my rooms is because our trades 30 days and shorter. So important to understand that. Okay, this one may be a little bit harder to see. We're going to talk about VIX a little bit here. Let me see if I can actually blow this screen up a little bit. I don't know if I can make this any bigger. I'm looking here, but oh wait, maybe not. There we go. There we go. Okay. I put two things on this screen here. Okay, on the left side. Remember, VIX is a futures product. Okay, it differs from stock options or equities that we trade, because regardless of expiration date that we use for one of our trades in a stock in Palo Alto, Nvidia, whatever it is, those options are all tied to the same exact stock price, right? So if I'm trading a January 31st option in Palo Alto, that's tied right now. Palo Alto is trading 170.20. If I'm trading a March option in Palo Alto, that option is tied and valued off of the stock being 170.20. Futures products are different. Okay. The VIX is a futures product. So you can see here, if I'm going to trade a February option in VIX, and you know what I'm going to do is, see, I really want to make this a lot bigger right now. Let's do that. There we go. We'll just focus in right on that. Hopefully you can see that better. Okay. If I'm going to trade a February option on VIX, here's my stock price. Even though it's a future, that's what I'm going to base my stock price on. If I'm going to trade a June option, okay, I'm going to base it off of that. Now, what we see right here is that the futures curve in the VIX currently, it's pretty flat, right? There's very little change from right now, the current spot price out in the future. So it is very, very flat. Typically, though, let's see if I can make this bigger now over here. There we go. Okay. Typically, we see a much steeper curve. We see a much steeper curve. Okay. Right now, it's really flat. But what you have to remember, if you are trading any futures product, and in here it's really just the VIX of what we're trading in terms of a futures product, you have to base your expected move. You have to base everything that you're making your decision on based on where the VIX is trading for the time period that you want. All right, guys, let's go to the for the wheel here. Okay, today's word is V. Tried to get cute with it, but yeah, I don't know. V is what it is. 22nd letter, I could have put 22 in there, right? For 22nd letter of the alphabet, but let's get everybody on the wheel. And, as you type that in, smash the like, guys. Smash the like. Help me out. Help us out here. F11. Okay, you want me to type F11 here, Mike? F11. What did that do for me? Oh, that was just, I see what you're saying. Okay. Didn't get me the, got it. Didn't get me the chat. Okay. V for VIX. Okay. Now, I'm going to go back to something we were looking at yesterday. Remember yesterday we were comparing VEGA to expiration dates. And we saw the further you go out in time, the more uncertainty there is, right? A lot more can happen out 6 months, 12 months than in the next 2 weeks. So that VEGA component, the volatility measurement, is much higher. So what I have on the board right here, guys, again, Palo Alto stock is 170. So if we look at the 170 option, remember I say option because the VEGA of a call and a put are the same. we see it's roughly 23 cents. Okay. If we move out to June, that VEGA is now 45 cents. Okay. So what happens if you think of it, it's doubled in 3 months there, or 4 months, whatever it is. Okay. The sensitivity of an option in June is way more sensitive to a change in volatility than it is in February. Well, look back now at our implied volatility charts for comparison. Okay, here is our 30-day implied vol, so like that February option. Here is the 90-day. Okay, I know the June is maybe 120. Yeah, it's probably actually 120 days. So let's do that instead. Okay, so we don't get as big of a disparity, right? We don't see as much of the highs and the lows. It's a little bit smoother, but that is because it takes less of a change in implied volatility to affect a longer term option than it does an option with a closer expiration date. And that is because of the VEGA. Okay, so it doesn't take as much to affect the price of an option, which is why you see that graph really condensed. Okay, does that make sense for everybody? Okay. All right, last call here, guys. I don't know if Mike had put that out here. Last call for the wheel. And then we're going to be off tomorrow because the markets are closed tomorrow. Friday, we're going to pick this up and we're going to have an extension talk even more about volatility and what it really means in terms of the expected move. So what your options are, just said the shorter the time frame left becomes more volatile. It does. But what happens to the VEGA? Okay, as we get closer and closer to expiration, what happens to that VEGA number? Okay, what are your options or anybody else? What happens to that VEGA number as we get close to expiration? Exactly. Less and less and less. So it takes a lot more movement in volatility to have any sort of impact because the VEGA number is so small. Okay. Does that make sense to everybody? I said this yesterday, and I'm not sure that it really held for the rest of the day, but since we started market binds, S&Ps have rallied 30 plus points. Let's hope that can hold in there. And before we go to the wheel, which is ready now, okay, before we go to the wheel, I don't do this very often. Okay, I don't know if anybody here is spiritual, whatever. I'd literally like to just take 2 seconds for everybody to just think of everybody in California affected by these fires and just hope and pray that everyone is safe and we get this thing under control because this is really catastrophic. I know I personally have family that's in the way of it right now, but if everybody can just take 2 seconds, that would be awesome. All right. Thank you. Let's go to the wheel here, guys. All right. Let me go back here. Yesterday, we had, who was our winner yesterday? Craig Hertzfield. So, Craig, if you win today, sorry, you ain't winning twice in a row. I see your name on there, but that'd be great. And then on Monday, we had two winners. Monday, we had. Come on, where are our. Oh, there we go. Ricky Huffmeyer and Nico. All right, here we go, everyone. Let's get it rolling. Boom, boom, boom. Today's winner is Gilbert, or what your options are. What your options, the trading den. I know you've been active in the chat. Are you still here? I know you've been active in the chat, which is great. Very much appreciated. Are you still here? Gilbert, yeah, you were a tick away. Awesome. Awesome. Okay. Make sure, I really wish that I could still find how to chat in here. So, Mike, if you can put in the chat for everybody here to please email me, or for what your options, please shoot me an email, prosperswag@prospertrading.com. And again, if you can also, there we go, thank you. Mike, if you can also put up one more time the link to yesterday's trading matrix that we put up, that would be awesome. All right, everybody. Again, markets closed tomorrow. We are off tomorrow. We'll see you back on Friday from the trading floor down at the CBOE. We will continue a discussion in volatility and how it relates to expected move. Thank you, everybody. Have an amazing rest of your day today. See y'all later.